It's just an internal shot of Lelucia Mall down in Durban. If we look then at the operational review, so the operational divider, etc., is not on this presentation. If you look at the operational review and the operating environment, net property income. So as opposed to distributable income, here we look at net property income. 67% of the total coming from the South African operations, ex-V&A. 26% coming from Australia, and then the V&A making up 6.6%. And by value, the SA portfolio is about 65%. Australia is 27.4%, and V&A is 7.8%. If we focus on the South African operations, you can see the mix between the retail, office, and industrial properties contributing to net property income. So of the 3.6 billion of net property income in South Africa, 32% was generated by the retail portfolio, 44% by the office portfolio, and 23% by the industrial portfolio. Obviously, the greater contribution from the office portfolio reflecting the acquisitions of the Tiber and AppSec portfolios during the period. And in that regard, AppSec was in the numbers for 6 months, and Tiber is in the numbers for 4 months from the 1st of March. If you look at the number of properties, 436 properties, 9.4% of the number of properties are retail, 37% are office, and 52% are industrial. And by value, 32% retail, 49% office, and 18.8% of the 49.3 billion total SA assets is industrial. An analysis of net property income. As we mentioned, the gross property revenue for the SA entity growing at 10.4%. Retail grew at 4.4%, obviously impacted there by some disposals. The offices grew at 17.5%, impacted by the acquisitions on the other hand, and industrial at 7.2%. Pretty neutral, if you want, in terms of the impact of acquisitions and disposals. The property expenses, retail grew at 4.6%, office grew at 17.3%, and industrial at 8.8%. Net property income then up 10.3% to 3.6 billion. The adjustments at 585 million, reflecting the impact of acquisitions and developments and disposals, and the Investec rent. So if we try and show you what happened on a like-for-like basis, so without the impact of the acquisitions and disposals, we get to a number of around 6.7% growth in net property income on a like-for-like basis. Retail at 8.2%, office at 4.6%, which has been impacted negatively by one particularly large vacancy, the old Ernst & Young building in the office park across the road from the Wanderers. If that property were to be excluded, the like-for-like growth in the office sector would have been 6.4%, and industrial on a like-for-like basis grew at 7.3%. Just on that Ernst & Young building, we have subsequent to year-end disposed of that building, and at a pretty significant profit to both book value as well as cost. Those numbers not impacted or not reflected in the June 14 numbers. Key performance indicators for the South African portfolio: the vacancies at 4.9%, up from 4.4%. There is an impact in there of acquisitions, so you might question why we might buy properties with big vacancies in them, but Engelbert assures me that there was a strategic reason for buying some of the industrial properties that he bought that had in excess of 50% vacancies in them. So I've done the calculation myself. If you strip that out, the impact of these acquisitions, there was about 55,000 square meters of vacancies across the portfolio or the properties that we bought during the period. If you strip that out, for all intents and purposes, vacancies remained at or about the 4.4% level. Total arrears are up 29.9 to 34.7. Again, that looks like an untoward increase, but you've got to appreciate that this is off a much bigger base, including the total 7 billion rand worth of Tiber and ABSEC portfolios. We also measure our arrears as a percentage of total monthly collectibles, one of our other key ratios we monitor. And at 34.7 million, that represents 5.5% of gross monthly collectibles, which is one of our lowest ratios in the last 3 to 4 years. Bad debts, the charge to the income statement, provision for bad debts at 14.1. The actual bad debts written off through the income statement, or the charge to the income statement, rather, 6.6 million. In-force escalations across all the portfolios, 8.1%. Renewal success rate, 65.7%. The weighted average renewal growth rate at 3%. Weighted average future escalations at 8.3%. Number of employees, you see quite a marked increase in the number of employees. Obviously, with the take-on of Tiber and ABSEC, we also took across the staff. There was in excess of 60-odd people that came across with those acquisitions. And the net property income per employee at 6.8 million rand. If we touch briefly on the retail environment and some of the dynamics in the retail portfolio, Stefan's here today, so you're welcome to ask him all the tricky questions, but he's a very proud recipient of the IPD award for the highest annual total return for retail portfolio over the past 3 years, where his retail portfolio outperformed the IPD benchmark by over 3%. I think it's fair to say that retail trading at the shopping center levels is reflecting a deteriorating consumer environment, with turnover at our top 16 centers increasing by 6.5%. That excludes the Waterfall Mall in Rustenburg, which we talk about separately. The prolonged strike in the platinum sector affecting the whole of the Rustenburg region did result in turnovers at our Waterfall Mall shopping center declining by 7.8% on a year-on-year basis. Stefan assures me he's not that concerned, as the trading densities at the shopping center still remain at a healthy 2,400 rand per square meter, which is significantly above some of the trading densities on some of the newer developments that we're seeing in town. So clearly the direct impact of that on us is not as marked, in that it only filters through as and when we need to renew the leases in those shopping centers. And if the turnovers have been declining, their rent has been contractually escalating at 8%, it means their cost to turnover ratios or rent to turnover ratios have increased. So when you come to lease renewal, you are a little bit on the back foot, and you might not get quite the increased rental on your renewal that you might have hoped for. But that only manifests itself over time as those leases come up for renewal. Portfolio value increased by 5.6%, and the net property income by 4.3%, both of them impacted negatively by the disposal of 386 million rand worth of non-core retail properties. The office and storage vacancies within shopping centers represent 1.2% of the overall vacancy. So if you look on the right, the vacancy increased from 3.7 to 4.5%. And one might get a little bit alarmed by that. I think we need to give you the full picture that we do have a number of properties in Stefan's retail portfolio that actually have offices as an integral part of the shopping centers. Brooklyn Mall is a good example. Golden Acre in Cape Town is a good example. And the one I can never remember, Estienne, is the one in Cape Town. Hey, Middestad Mall, I'm sorry, yeah. Never remember the name of that thing. Middestad Mall also has a big office component, so we don't strip that out and show that it's part of office. We just include that in the retail GLA. So if you strip that out, the 4.5%, deduct the 1.2, the true retail vacancies is then only 3.3%. And then within that, there is 0.8%, which is technically unlettable. Now, it's not unlettable because it's dodgy space. It is unlettable because it is in the process of being redeveloped. So it's in the process of being improved and let. So that is also in the number. So the true core industrial vacancy is actually only 2.5%. Total retail portfolio arrears was up 6% on FY13, but as a percentage of collections, it remained the same at about 9%. So retail runs at about 9%, office and industrial run at somewhere between 3 and 5% of gross monthly collectibles. The portfolio historical renewal success rate of 80% has declined to 75%, mainly due to the non-renewal of 2 new metro leases in 2 of our shopping centres, which accounted for 7,000 square metres. On the redevelopment side, Brooklyn Mall, Colonnade, Northgate and Warmer all completed on time and within budget, slightly higher yields than what we originally planned. The retail portfolio remains relatively insulated from the negative macro consumer dynamics, given the overweight exposure to the high income market. So the bulk of our shopping centres are in the major metropolitan areas, not in the rural areas, and we're seeing that it's slightly more defensive in this current economic environment with the consumer being under pressure. One of the new initiatives, I think, at the shopping centres is a partnership that we have with Internet Solutions, transforming our shopping centres into what we call smart malls, where we've installed open access fibre optic networks within 17 of our major shopping centres, which offers improved connectivity to the tenants as well as free internet to the shoppers. Now, I don't see this as being a major revenue spinner for us, unfortunately. It's almost become a competitive, it's not even a competitive advantage anymore. It's become a necessity. You know, many shopping centres are sort of offering this, and I think you're at a disadvantage if you don't do it. So it's become a business imperative to look at that. On the office side, net income up 17.5%, obviously impacted by Tiber and APSEC. Portfolio value increased by 50% after adding APSEC and Tiber, so very significant. I think if you add all the investment activity that we did during the year, you're not far off 15 billion rand worth of investment activity, which is certainly the largest or the busiest year from an investment perspective that we've ever had. Market conditions in the office sector remain challenging, with vacancies up to 8% from 7.8%, but they still remain well below the national office vacancy average of 11.3%, probably in our view reflecting the underlying quality of the office portfolio that we have. I have to stress, though, that it is very competitive out there in the office space. Every landlord who has got office tenants or office exposure is looking to steal our tenants. We're looking to steal their tenants. We're trying to desperately hold on to our tenants. I wouldn't say at all costs, but it's certainly, you know, every year I think we keep commenting on how competitive the office environment is, and I have to say I think every year it continues to get even tougher. So it's definitely very competitive out there. We let 258,000 square meters of space in the year. 143,000 of that was space that was renewed, and 115,000 square meters of space, of new space that was let. The renewal success rate has dropped, as you can see on the right-hand side, to 63%, clearly reflecting these tough conditions. The arrears have increased due to basically just the increase of the size of the portfolio. You can understand if the size of the portfolio doubled or went up by 50%, then you would expect your absolute arrears number to also go up. We're busy with 5 new developments that are underway across the country, adding 78,000 squares at an overall cost of 2.3 billion, the biggest one within that obviously being the Discovery head office development here in Sandton. Focus in the office sector is going to be on tenant retention, cost control, optimizing and improving the performance of the newly acquired properties, and ensuring that their effective integration into the existing portfolio. On the industrial side, still also experiencing challenging conditions, considering the labour unrest, input cost increases, the impact of utilities and e-tolls, and the volatile exchange rate on the import and export sectors. Significant increase in supply in the last 12-18 months, specifically your big box generic type warehouses. The emergence of new industrial nodes at below market rentals to stimulate activity. So you're seeing developers get zoning for new industrial, let's say, plots or new industrial nodes. And in order to get those going, the guys are being very aggressive in terms of offering new developments to tenants and discounting rentals or going in at low initial yields just to get the projects underway. Acquisition growth is limited due to scarcity of quality and the low cap rates, very expensive. We've seen some very, very large industrial portfolios recently that have been on the market. I'm thinking of Score Metals portfolio. I'm thinking of the Robor portfolio. And I know that I think one of the major construction companies are currently out effectively on like an RFP tender process to sell their entire portfolio. It's also well in excess of $1 billion. We've had a very, very good look at those. We always look at everything, but we don't always participate. And we chose not to participate in some of those opportunities. From the portfolio perspective, I think it's a pretty sound performance in industrial, given the trading environment. The focus is pretty much on the basics. Arrears, managing arrears, vacancies, trying to lengthen the lease periods. It's actually it's quite disheartening when you see how short the lease periods are here in South Africa, where we're sitting at, in most instances, at below 3 years. I think Engelbert, who's also here today, is struggling to get an average of 3 years lease length in his portfolio. And we look at the Australian situation on the other side where we're involved, and we see almost a norm is 10 and 15-year leases. In South Africa, with the size of our portfolio now, we are renewing in excess of 1 million square meters of space every year, which obviously comes at a cost. So we have made a couple of strategic land acquisitions this year, and one in particular out in Midrand. And we look forward to participating in some new development of new modern industrial stock. And we do have, and we have built over the last couple of years, a core competency in developing industrial properties, which is to the benefit of that team. Strategically, just want to keep doing the basics right, focus on the core portfolio and extract value to convert the dirt. But it's an ongoing program. Obviously, there's, it's a 2.5 million square meter portfolio, and there are significant opportunities in that to convert older stock to newer, more modern stock. Right, that's the South African story. If I move on to Australia, I'd urge you, for those of you who've got an interest in the Australian entity, to go onto the Growthpoint Properties Australia website and download their investor presentation. It's a really good document. In fact, this year they chose to show a 5-year history, which pretty much coincides with the period that we've owned. We made our acquisition there in September 2009. So that document gives you a beautiful explanation and picture of the last 5 years and how that company has transformed to what it is today. And there's a lot of detail. As much detail as we provide is provided by the Aussie entity in their presentation. If we look at the portfolio overview of the Australian business, net property income at 1.4 billion, office sector making up 47% of that, and industrial 52%. Number of properties, we're sitting with 51. We had another busy year in Australia. We was up from 44 the previous year. We invested over $350 million into new properties in Australia. It doesn't sound like a lot in dollar terms, but to multiply by 10, that's 3.5 billion rand. It is quite significant. And then if you look at the portfolio by value, you're looking at roughly a 50-50 split between office and industrial in Australia at the moment. Key performance indicators there, the vacancies at 1.5%. Your total arrears, this is in rands, so 6.9 million rand. You can see not a hell of a lot when you convert it into dollars, about $690. Used to saying million behind everything, or billion. Provision for bad debts is sitting at R1 million. The bad debt charge to the income statement was not even R1 million. The average in-force escalation there, 3%. The renewal success rate, 76%. And it's quite strange looking at these Australian numbers, because you look at the renewal success rate and the number of leases that had to be renewed and the square meterage that had to be renewed, and you compare that to the South African business, and it's almost laughable. I think that renewal success rate reflected the results of renewing 3 leases, if I'm not mistaken. The weighted average renewal growth rate that we're seeing on those that were successfully renewed, 2.7%. The weighted average future escalations on the renewals, 3.5%. And as I mentioned, 12 employees. Obviously, our business model there is slightly different, where we don't perform property management in-house in Australia. We only perform the asset management. So we've got a lot fewer people in the Australian business. We declared a distribution in Australian dollars of 19 cents for the year to June. That was up 3.8% in Aussie dollar terms on the previous year. The annualized dividend per unit yield is sitting at about 7.8% based on the closing price of $2.45. We invested $352 million in new property acquisitions during the year. It is a wonderful portfolio with quality tenants, diversified across office and industrial, and we have properties in every Australian state in the country, as well as in the capital territories in Canberra. The weighted average lease length, you can see there, is more than double what we have here in South Africa at 6.9 years. And the vacancy and limited lease expiry risk in the short term, 1.5% vacancy. Loan to value, 40%. 82% of our debt there is hedged with an average maturity of 3 years. And the weighted average debt maturity in terms of the length of the facilities is 3.1 years. We recently undertook to get a rating of the Australian subsidiary, and Moody's was appointed. And they have given us a senior secured debt rating of Baa2 with a stable outlook. So we, at the moment, are still 100% dependent on funding from the banks in Australia. Admittedly, the environment has improved dramatically from what it was when we went in there in 2009. Every year between 2009 and now, I think dealing with the banks has become easier. They've been more willing to lend. They've been giving longer term, and they've been bringing down their margins. So it's been pretty good. But we still feel the need to look to diversify away from just being purely dependent on the banks. So we will be looking at a debt capital market program there in the next 12 months. Strong support from the shareholders, obviously from South African side. It's been a great investment for us. We continue to look to support there. And the total return in dollar terms was 10.8% on total shareholder return in dollar terms for the year. V&A Waterfront. Net property income at 356 million. You can see V&A Waterfront's almost a mixed portfolio in itself. So you've got exposure there to retail, you've got exposure there to office, fishing and industrial, as well as hotels and residential. Key factors there, or key performance indicators: vacancies, pretty low, 1.5%. Arrears, 25 million. Provision for bad debts, 6. Bad debts written off. In fact, there's a credit to the income statement. This year we reversed a provision. For many years, certainly since we've been involved, the V&A was in dispute with some of the homeowners in the V&A Waterfront, in the marina, the residential marina development. That dispute has been resolved. We did have a provision there that, for write-off on certain monies that were owed to us by the homeowners. We managed to recover those monies, and we've reversed the bad debt provision. Average in-force escalation, 7.8. Renewal success rate, 89. Weighted average renewal growth rate at 4.9. Weighted average future escalations at 7. We've got 178 employees down there at the waterfront, and the income per employee at about 4 million. The waterfront, Mike, as you said, Cape Towns think it's not part of South Africa, but I have to say, if you look at the trading statistics of the waterfront, it actually is a slightly different country almost to the rest of the country. I think you saw from Stefan's slides, his top 17 centres showed about 6.8% growth in turnovers. Waterfront is showing growth of over 20% in turnover. And obviously there's some additions that we've made there, Pick and Pay, etc. If you strip that out and you look at trading density per square metre growth, you're looking at 19%. Now, unfortunately for us, so on the unfortunate side in Waterfall Mall, where the turnovers are down, we don't suffer an immediate negative consequence. The unfortunate situation is where we're seeing these sorts of dynamics, a 20% growth in turnovers at the waterfront, we don't get an immediate uptick either. We have to wait for those leases to come up for renewal, and we can then be on the front foot in renegotiating leases with the tenants, where we can argue that their cost to turnover and their rent to turnovers ratios have decreased significantly. If their rentals are escalating contractually at 8 and 9, but they're growing their turnovers at 19 and 20, then obviously we can be on the front foot when we renew some of those leases. The total retail vacancy is 1.7%, with the Victoria Wharf, the main shopping centre, being fully let. We've added about 8,000 square metres of retail with the relocation of Pick and Pay to the basement, and we've created flagship store for them down in the basement. And then we've also added the Cross Mall in order to create better circulation for what used to be called Death Row, or the mall with all the very high-end retailers in there. And it's been quite marked, the improvement in circulation and trading, by breaching through and creating the additional circulation. A whole string of new lettings, encouraging to see new international tenants being pretty keen to take space in the waterfront. I think more recently we've got a commitment from H&M, who will take about 4,300 square metres. We are also bringing in the likes of Mr. Price, who've never been in the mall. So we're trying to really focus on getting the mix right between satisfying the local demand from the local shopper as well as the tourist. A whole string of new stores in the pipeline. V&O Waterfront won an award again this year for attracting the highest number of visitors in any given day to any shopping centre, and it received another award for being the top shopping centre in the Western Cape. On the commercial side or office side, renewals were at 89%. Allan Gray has settled down, and the ex-Allan Gray and Chevron space has been re-let now. We refurbished the old Allan Gray building in Granger Bay, and we've got some pretty good tenants in there now. Total Gas, Red Bull, and EOH. If I'm not mistaken, there's only a couple of hundred square metres left in the old Allan Gray space that still needs to be re-let. The overall office vacancy in the waterfront sitting at 2.9%, well below national average of 11.3%. On the hotel side, we saw Hospitality Group come with results in the last 2 weeks, confirming, I think, the turnaround in the hotel space. And we're certainly seeing the impact of that down in the waterfront as well. So coming off a very, very low base, obviously following the 2010 downturn and the exuberance of 2010 with the World Cup here in South Africa, we hit very low, all-time lows at the end of 2010 into 2011. And we're definitely seeing, marked improvement in the hotel sector. Fishing and industrial, that whole node, if you want, remains pretty stable with no vacancies there. We've committed to sponsor or partly sponsor the Volvo Ocean Race again at the waterfront. We also participated in the tender that was put out. I know there was a lot written in the press recently about that tender for the terminal, a new cruise line terminal down in Cape Town. And we tendered to participate in that and take control, if you want, of that. Just to give you some comfort, we're not intent on spending hundreds and hundreds of millions of building a brand new fancy terminal. Instead, we're looking at renting some of the existing facilities that Portnet have got from them or Transnet there on a long-term basis, effectively, therefore, being in control of what happens when those ships dock, where at the moment we've got no control whatsoever. We certainly believe that there's no merit in spending hundreds of millions just by building a new cruise liner terminal. In no way suggests you're going to double the number of ships that come to Cape Town. The global cruise liner business is a fascinating space. Unfortunately for us, South Africa is very far from where the real money and the real volume of people sits, which is obviously the US and the European markets. And to get to Cape Town, it's a couple of weeks, maybe 2 to 3 weeks of sailing, and people find that quite boring. They want to be able to hop off and hop on to a ship, sort of, they don't want to be cruising for more than 2 days at a time. So anyway, we're staying on top of what's happening there. On the residential side, we converted the old Allan Gray office space on the Portswood Ridge to 114 residential units, which are pretty much ready for letting at the moment. This is a new income stream for the waterfront, so as opposed to just selling the properties on sectional title, we're trying to create a new long-term growing income stream. And 70% of the first block has already been let. The number 2 silo residential, which is the residential that we built next to Allan Gray, 31 units were built, and there's only 1 that remains unsold. And lots of awards for that particular development, as well as the Allan Gray development, receiving the 6-star Green Star rating. That's the Allan Gray, and the residential receiving a 4-star Green Star rating. The first one, first development to residential development to get a Green Star rating. And then for those of you who do go to the waterfront from time to time, you'll also notice that on top of the breakwater parking garage, we are almost complete in adding another 151 residential units that will also be residential units to let. And that development should be complete towards the end of the year. So on the development side, successful completion of a number of developments, the Cross Mall, Pick n Pay, the tunnel underneath, from Pick n Pay underneath to linking the breakwater parking garage. So a hell of a lot going on there at the moment. Number 1 silo, as I said, got all those green awards. We're spending about 46 million rand upgrading and extending the aquarium. That aquarium has not seen any money spent on it for a number of years. We're also spending approximately 15 million redeveloping the old blue shed, which is to be renamed the watershed, and that will create some really fantastic space for about 150 traders, showcasing some of showcasing some of the sort of arts and craft, best arts and craft that you can find in the country. The museum and the conversion of the old silo, grain silo, getting a lot of attention, and that's definitely gaining momentum. So we've just seen the increased interest to create effectively almost a precinct. We've seen a number of galleries approach us recently who want to establish themselves in the waterfront. They are all over Cape Town, and we see the waterfront as becoming a top global or world destination for art and art lovers. So the remainder of the silo precinct, I think the silo precinct, for those of you who don't know, is the waterfront's got 13 precincts, but the silo precinct is the one where the old grain silo building is. And if you can picture that as being the center piece, if you want, of with a number of developments coming around it. Allan Gray's already there. The Allan Gray residential, or Silo 2 residential, is already there. Silo 3 will be more residential. Silo 4 will be a 4,000 square meter Virgin Active gym, which will also act as a podium for office development. Silo 5 to be built on top of that. That'll be a 14,000 square meter office development. We've already got pre-commitments for that, so we're just finalizing planning. It's already pre-let, so it's not spec development that we're doing there. And then Silo 6 will be a 200-room hotel, internationally branded, more business-type hotel, We're down to a short list of 4. We're just doing the final evaluations on which proposal is the best financial proposal for us as the owners of the waterfront, and we will push the button on that hopefully in the next 3 to 6 months as well. And that'll essentially complete the entire silo precinct and utilize all the bulk that was allocated to that particular precinct. So very exciting. There's 3 billion rands worth of spend. Obviously our share of that is only half, 1.5 billion. But over the next 2 to 3 years, you'll see a complete transformation of that silo precinct. And then the shopping center side, again, strong demand from retailers. We have applied. We're in the final throes of getting planning consent for 15,000 square meter extension to the Victoria Wharf shopping